name is Andrew Betwain. I am the managing editor of insuranceinvestor.com. And today I am joined by Matt Pitzer, Director of Private Markets at Shelter Insurance. Matt, how are you?
Great, Andrew. Good to see you today.
Fantastic. Thank you for being here with us. Well, Matt will be speaking at our Insurance Investor Spring Conference in May in Chicago. He'll be taking part on a panel discussion on the changing shape of real estate markets. How viable is commercial real estate in a post-COVID era? And where are the opportunities to enhance portfolio allocation? So it's a big, meaty topic with lots to discuss. It's a really big sort of topical news item as well. So it's been discussed a lot in society and also in the business newspapers. So Matt, I want to get your thoughts on this. And my first question to you is, commercial real estate has been in the news as a crisis area over the past few years due to the working from home moment. And are there new changes around policies that you're seeing? And how is the market opportunities being impacted by it?
Yeah, it's been a really interesting, several years really since COVID, just because of the changing nature, as you mentioned, and how people use real estate. So I think we're still seeing that evolve. I'm not sure that corporations, broadly speaking, have figured out where their ultimate sort of endpoint is and with the working from home dynamic. But the one, sort of constant theme or trend that you see is that companies by and large are taking less and less space. So whatever the situation, whether even if they're going out and building a new building, or they're, releasing space, whatever they're doing, they are just taking less space than they did before. And so that is, and I'm speaking mostly about the U.S. Because that's where we mostly invest. But what that means by and large is that the whole U.S. market is just massively oversupplied in office. And that's going to take a long time to sort of work through and work out. And you're going to have, sort of crises, pop up from time to time with different institutions. And I expect, like I said, this to take a long time to, sort of play out. But it's also created, new opportunities in other segments and other sectors that were not as prevalent, in the investment community before. And those have been some of the, sort of non-traditional sectors that have really continued to thrive and perform well, even as office goes through this dislocation.
And building on that, you mentioned those crises. So what are the most significant challenges that you're seeing this year?
So I think that the real estate debt overhang is going to be, a crisis, or, it'll be a crisis that sort of ebbs and flows. But that's going to be the thing that is probably top of mind and comes up, again and again in conversation. But I also think it's important to remember that is largely confined within the office segment. There may be spillover effects for an institution, for a bank, or some other type of lender who has, crisis in their office loan book, and they need to, liquidate something somewhere else in order to, help solve for that. But we're not seeing that crisis sort of mentality in other property types. So I think that's important to remember just when you see headlines and when you see discussion about it. So we don't have a ton of office debt exposure. I think that a lot of people will, on the equity side, will have to come to the realization that their office positions are, if they haven't already been marked down by a lot, they need to do that, and just come to grips with that, and then we'll be able to sort of correct and move on to some of those more interesting ideas that I mentioned.
Yeah, and I want to build on those with my next question, actually, because conversely, where are the biggest opportunities for enhanced allocation? Do you see a rebound coming, or maybe you've already answered this a little bit, but is there more of a seismic shift underway, maybe in terms of people working from home for the long term and more, technology enabling more people to work outside of an office in general? What are you seeing?
Right. Yeah. Well, I do think there is a seismic shift underway, for real estate investors. For a long time, it was, looking at the four major food groups within real estate. So being, multifamily, industrial, office, and retail. And, there were whatever benchmark or index you compared yourself to, you'd look at, the benchmark weights for those sectors and then decide if you wanted to be a little bit overweight in one or a little bit underweight, et cetera. So the seismic shift comes from the fact that office, weight in that benchmark is, has already come way down and is, going to continue to come down. And so that has a significant effect on portfolio construction going forward. And it's those other areas where investors have seen their allocations, really, really ramp up. So, since COVID, everything has been beds and sheds, right? Apartments, single family rentals, and then industrial logistics. And so those sectors have, saw a ton of capital flows since 2020. I think those, that sort of acceleration of capital flows has certainly stopped into those sectors. It hasn't reversed necessarily, but we're not going to see continued growth in terms of allocations. So it's, how do you want to play, all real estate beyond that? And that can be storage, that can be medical office, that could be life sciences, that could be, sort of new retail, things not in the large mall space. So, and then there's, sort of the newer office or office of the future, idea, which I think there'll be a very, small percentage of those opportunities that are really successful, but there will be, some opportunities there as well.
My next question on that is, where do you foresee the next 5 to 10 years taking us in terms of allocation in CRE? And I want to focus on those areas that you were just talking about, as well as the ones you didn't mention, such as hotels. Which areas are the healthiest, and where are you seeing the most change?
Yeah, so I think the whole hotel and leisure segment has become, really interesting, just with, how consumers are spending so much, more of their dollars on leisure and hospitality opportunities. So, and that seems to be a trend that's sort of, gone up a level in terms of that consumer dollar since COVID. And so you're seeing a ton of really interesting opportunities in, sort of that mid and upper, semi leisure type of hospitality, or semi-luxury, I should say. And so, there's going to be there's a lot of, new development, new construction, and new vacation and leisure destinations. So that's going to become a part of it as well. But one other interesting thing I'll say about the portfolio construction for some of these other segments is that traditionally these segments have been relatively small allocations. So it'll be, one dynamic to watch is just when you see that allocation increase. Let's take storage, for example. Maybe it was a allocation in the low single digits for most investors. If everybody suddenly goes to 10 or 15% of their portfolio in storage, that's a huge amount of dollars that come into the space. So is storage ready for those increased institutional capital flows? Is it ready to kind of scale to a level where retail and some of these other segments have been, and that'll be a challenge. There'll be some bumps along the way, but that's another thing that will sort of drive returns for some of these sectors that had been smaller allocations.
Very interesting. So my final question, I want to build on all of the topics we've just discussed, and real estate in general, with all the challenges and opportunities you've just mentioned. So how can insurance investment teams enhance the resilience in their portfolios from lessons they've learned over the past few years and going forward? And probably with the idea for a lot of them to ensure diversification, is there any re-angling or a pivot needed in the industry, do you think? Or do they have their own resiliency plans already quite well established?
Yeah, I feel like in terms of having that proper diversification, there are a lot more angles that individual investors can pivot to now than a couple of years ago. Like I mentioned before, for a long time it was, figure out those 4 major food groups and, move your weights around a little bit. But that, I think, paradigm has really broken down, and there are a lot of specialized opportunities within real estate that are much more capable of driving portfolio returns today than, let's say, 5 years ago. And so what that means is that you're going to see investors have portfolios that look a lot different from one another. And those days of just sort of that blanket allocation or, kind of put it on autopilot, I think that those days are gone. And we all need to be a lot more active and a lot more constructive in forming our own opinions about, whether we like storage versus, leisure, and how we want to, build those allocations within our portfolios. So bottom line, I think investors need to be much more active and forward thinking in how they think about real estate. And they also need to be more dynamic and more willing to take chances, or to take prudent chances on the segments that they feel really constructive about.
Right. Well, thank you very much for those very interesting answers, Matt. It's been great to speak to you. And if that has whetted your appetite about hearing more on commercial real estate, please do visit the website to register to attend Insurance Investor Spring, which, as mentioned, will be taking place in Chicago in May. Thank you very much for watching, and thank you very much, Matt, for your time.
Thanks, Andrew. Good speaking with you.